The Gateway to Digital Gold, a comprehensive guide to iShares Bitcoin Trust, IBIT. As of January 27, 2026, the iShares Bitcoin Trust, ticker IBIT, has moved beyond being a new financial experiment to become a dominant fixture in global finance. Managed by BlackRock, the world's largest asset manager, IBIT has effectively bridged the gap between the volatile world of cryptocurrencies and the regulated, structured world of traditional brokerage accounts. For an investor today, IBIT is the primary vehicle used to add Bitcoin to 401ks, IRAs, and standard investment portfolios. With assets under management surpassing $70 billion this month, it is now one of the most liquid ETFs in existence. This guide explores the mechanics of spot Bitcoin ETFs, the 2026 cost structure, and the significant risks of holding a digital asset that, while now institutionalized, remains one of the most volatile investments on the planet. 1. What is IBIT, the spot revolution? To understand IBIT, you must understand the difference between spot and futures. Spot Bitcoin. This means the fund actually buys and holds the physical, digital Bitcoin. When you buy a share of IBIT, BlackRock, through its custodian, Coinbase, must go out and buy a corresponding amount of real Bitcoin and lock it in cold storage, offline vaults. Direct correlation. Because IBIT holds the real asset, its price moves almost exactly in line with the current market price of Bitcoin. If Bitcoin goes up 5%, IBIT should, in theory, go up by roughly 5%, minus a small management fee. The BlackRock Seal. For many investors, the biggest hurdle to buying Bitcoin was trust. IBIT removes the need to deal with offshore exchanges, digital wallets, or private keys. You buy it through your familiar broker, like Fidelity, Schwab, or Vanguard, and BlackRock handles the security. 2. The 2026 landscape, market dominance and liquidity. Entering late January 2026, IBIT is the Goliath of the crypto ETF world. Its massive size is a feature, not just a statistic, because liquidity is king in volatile markets. Key statistics as of January 27, 2026. Total assets, total around $70.24 billion. Average daily volume frequently exceeds 50 million shares, rivaling major indices like the S&P 500, SPY. The zero dividend. Bitcoin does not produce cash flow. Like gold, IBIT pays no dividends. Your entire return depends on the price of Bitcoin going up. Options trading. As of early 2026, IBIT has a robust options market. This allows advanced investors to buy insurance, puts, or generate income on their Bitcoin holdings by selling covered calls. 3. The cost of ownership, fees, and hidden drags. One of the most attractive parts of IBIT in 2026 is its competitive fee structure, which has forced many older crypto funds to lower their prices. The 0.25% expense ratio. BlackRock charges an annual management fee of 0.25%. For every $10,000 you invest, you pay $25 per year. The comparison. This is significantly cheaper than the 1.5% to 2% fees common in closed-end trusts just a few years ago. The fee waiver period. It is important to note that the early teaser rates from 2024 have expired. Investors are now paying the full standard rate, which is the industry benchmark for spot products. Tracking error. Because the fund must pay its 0.25% fee by selling a tiny fraction of its Bitcoin every year, IBIT will naturally underperform the raw price of Bitcoin by that exact 0.25% over time. 4. IBIT versus self-custody, the great debate. Even in 2026, crypto purists argue against ETFs. Before you invest, you must decide which philosophy fits you better. The pros of IBIT, the convenience case. Tax efficiency. You can hold IBIT in a Roth IRA, meaning all your Bitcoin gains could be tax-free. You cannot easily do this with physical Bitcoin. Security. If you lose the password to your digital wallet, your Bitcoin is gone forever. With IBIT, if you lose your brokerage password, you just call customer service. Estate planning. Passing Bitcoin to heirs via a will is legally complex. Passing ETF shares is as simple as any other stock. The cons of IBIT, the autonomy case. Not your keys, not your coins. If you own IBIT, you don't actually own Bitcoin. You own a debt obligation from a trust. You cannot use IBIT to buy a coffee or send money to someone in another country. Market hours. Bitcoin trades 24/7. IBIT only trades when the US stock market is open, 9:30 a.m. to 4 p.m. ET. If Bitcoin crashes on a Sunday night, you cannot sell your IBIT shares until Monday morning. Centralization risk. By holding IBIT, you are trusting BlackRock, Coinbase, and the US regulatory system. For those who buy Bitcoin specifically to escape the banking system, IBIT is a contradiction. 5. Critical risks, the bear's case for 2026. Bitcoin is currently in a maturation phase, but it remains a high-stakes asset. Extreme volatility.
Despite institutional adoption, Bitcoin can still drop 10% or 20% in a single day. In late 2025, we saw a flash crash where Bitcoin dropped from $90,000 to $72,000 in less than a week. If you cannot handle a 30% drop in your portfolio, IBIT is not for you. Regulatory uncertainty. While the SEC approved spot ETFs in 2024, the rules of the roads are still being written. Future changes in tax law, environmental regulations on mining, or anti-crypto legislation could send prices tumbling. The halving cycle aftermath. We are currently in the post-2024 halving window. Historically, Bitcoin sees massive gains in the 12 to 18 months following a halving, followed by a crypto winter. In early 2026, many analysts are warning that we may be approaching the top of this current 4-year cycle. Security breaches. While BlackRock uses institutional-grade cold storage, no system is 100% unhackable. A major security breach at the custodian level would be catastrophic for the IBIT share price. 6. Investor strategy. How to build your position. In 2026, financial advisors generally suggest a 1% to 5% allocation to IBIT for diversified portfolios. Treat it as digital property. Think of IBIT not as a currency, but as digital real estate. It is a finite asset, only 21 million Bitcoin will ever exist, that acts as a hedge against the devaluation of the US dollar. The rebalancing strategy. Because Bitcoin moves so much more than stocks, it will frequently take over your portfolio. If your 5% Bitcoin position grows to 10% because of a rally, sell the extra 5% and move it into something safer like VOO, S&P 500. This forces you to take profits at the top. Avoid the FOMO buy. Buying IBIT when it is at an all-time high is historically the worst time to enter. Wait for a correction of at least 15% from the highs before starting a new position. Conclusion: the new standard for crypto exposure. The iShares Bitcoin Trust, IBIT, has achieved its goal of making Bitcoin boring. And in the world of investing, boring is often better. By removing the technical hurdles of wallets and exchanges, BlackRock has allowed Bitcoin to be judged on its merits as an asset class, rather than its difficulty as a technology. The verdict: if you believe that Bitcoin is a permanent part of the global financial system, and you want the easiest, most liquid, and most regulated way to own it, IBIT is the gold standard. However, never invest money in IBIT that you cannot afford to lose. It is a high-risk, high-reward tool that should be the spice in your portfolio, not the main course.